Hi, everyone. Thank you for joining WisdomTree's office hours on Has It Become the Fed May or Will Cut Rates? Where you'll hear from Professor Jeremy Siegel, WisdomTree Senior Economist, Jeremy Schwartz, our Global Chief Investment Officer, and Kevin Flanagan, our Head of Fixed Income Strategy.
We're going to try to get straight to the point, give some quick comments on the Fed from the professor. It's always great to get his response. We'll talk about how we implement some of these in model portfolios as well. But Professor, people thought we'd be cutting by now. No cuts so far. What are you hearing from Powell? How are you thinking about the rest of the year?
Well, I think we need Powell to keep on talking because when he was talking, the Dow went up 400 points, and when he stopped, it went down 400 points. So they liked what they were listening to. I particularly like the terminology. I don't see stag and I don't see inflation. People have been talking about that. We've had some slower growth data and pesky inflation numbers. So clearly the term stagflation kind of became a kind of a nom de jour in the last few days. I did think yesterday, and I think everyone was pivoting way too bearish on, and they thought that Powell would pivot to a much more hawkish stance. He did not. There was no pivot, really. It was just a longer wait. He was not overly pessimistic. A number of the questionnaires tried to get him to say if there's a rate increase. He said that that's unlikely, and it said a whole bunch of indicators would have to go in directions that he implied are not going that way now. One person asked whether there was any discussion about a rate increase, and the way he answered it was there was discussion, but he didn't say that. And he said, the discussion is the discussion centered that we feel we are restrictive and it just takes longer for the time to work. He didn't want anyone to entertain an idea that the Fed was really even thinking about a hike. Now, of course, it cannot be ruled out, if situations are become extreme, but they're certainly not in any reasonable scenario. He talked about the rental again, finally taking hold. It said the lower rentals. He compared the VLS rental index with the current apartment list, Zillow. He didn't mention those names, but private. And when he did say that those were flat, it is taking time for those to get into the official index. It's getting into the official index slower than we had thought. So he actually conceded that. Basically, it was just a holding pattern. It was not a pivot. It was not a change in tone, implying that if data gets better going forward, he will lower rate. He also said if employment gets worse, and a later question said, well, what do you mean about employment getting worse? And he sort of qualified that by saying markedly worse. I mean, he sort of implied that going up from 3.8 to 4% was not enough. But if other indicators started deteriorating, they would. He said, in other words, we do have a dual mandate, and that we have to watch the employment numbers as well as the inflation numbers. So I thought it was a very excellent session. The only thing I didn't like was blaming the initial inflation on supply side constraints rather than his own excessive monetary policy. But that's in the past. Given what he is seeing now, he is absolutely taking, in my opinion, the appropriate. It's just, again, wait and see. We're going to get two more reports on inflation before the June 15th meeting. Actually, one comes on the morning of June 15th, the day that he's going to make an announcement. And, of course, the other one will come in the middle of May. So we're going to get an awful lot of data between now and then.
So, Professor, if you were to put your forecasting hat on right now, would you say that if they had a dot plot for today, it would have stayed at 3, or do you think it would have dropped to 2?
Oh, it would have dropped. I mean, I mean, it definitely. I mean, I was shocked that it stayed at 3, and I remember when it's in March it stayed at 3. I think only because one person didn't mark it up a quarter point. I would say it would be between 1 and 2 now. But take a look at the futures market. If I'm looking at the right variable right now, I'm seeing the January, which marks December Fed at 4.98. Actually, it was up at 5. That's just one. That's basically one cut. It's actually 3/4 of a cut. If you take risk premiums into account, it's a half to a 3/4 cut. So really, the market has washed out the cuts. And so if we do get cuts, it'll be favorable and it'll keep bond rates low. And I do think better inflation data is coming down the road. I'm particularly encouraged by the drop of commodity prices. Really had a drop of commodity prices yesterday for the first time in a long time, a big drop across the board. And of course, we've got oil also moderating recently. So the commodity indexes have taken their first big drop. Now they're still up from their lows, of course, that they reached last October, November. But there was a big surge 2 weeks ago. That has now been erased by the recent drops. That's encouraging going forward. We certainly don't need commodity inflation at the market level to complicate the official data.
So on that front, we just got a question from Joe talking about his viewpoint. Wage inflation is creating price inflation, and we're going to need a recession to reverse that. Would you agree with that assessment?
Well, first of all, he was careful. He did make the proper statement, wage increases above productivity. That's the only thing that is inflationary. And he did make those words, although sometimes he just talked about wage increases in and of themselves. Productivity was not good. We're going to get productivity next week. It looks that it's going to be 0.6% on an annualized basis, which is way below what the average has been, which was 2% last year. But if I look back last year, I think we got 0.6% in the first quarter. We also got a disappointment in the first quarter last year of GDP. So there's a seasonality that seems to lead to disappointment in GDP and productivity in the first quarter, with a hopeful bounce back in the second quarter. The only thing that's problematic about wages is wage increases above productivity levels. If we get a bounce back of productivity to 2023 levels, these wage increases are not at all inflationary.
Professor, when you talk about where the 10-year should be, there's a number of factors that go into it, but one of them is how stocks and bonds are trading together. Do you want to talk to people about your view on the 10-year, how it's sort of where it is versus that, and then sort of this new factor that people need to be thinking about?
Yeah, I mean, I've been saying that a major reason bonds are bought are hedging against risk assets, and they hedge against a lot of risks, recession risks, geopolitical risks, financial crisis risks, pandemic risks. They do not hedge against inflation risk. So the perception of how much inflation you might have in the future and is a negative for bonds, and bonds have to be a lot of the increase in the yield, in my belief, that we've seen is actually related to the fact that bonds have been are more worried about inflation risk, certainly, than they were in the 20 years that led up to the pandemic, that brought bond yields down to all-time lows. So a lot of that jump is that, and some of the jump is faster real growth, which we experienced certainly in 2023. And although we had a soft GDP report, by the way, Powell was not worried at all about that soft GDP. He talked several times that actually ongoing demand was 2.5%. He didn't say that started anything that looked like a big slowdown. He brushed it off. The Fed has forecast 2.1% for the year. I actually think it might be higher when we finally get this year out going forward. That's another positive push on interest rates going forward.
So we're always looking at the rate announcement and the press conference, and we did get an announcement today. They began to taper QT, or at least they will do it beginning of June. They made the announcement. So Bill just wrote in and asked, what are our thoughts? What are the implications behind the reduction in the Treasury roll-off?
Well, I think that was the first thing to kind of actually, I think the market reacted on the 2 o'clock report. They liked the reduction in the QT. On the Treasuries, it was below the expectation in terms of the reduction. They liked that. And that sort of said, well, if he was really worried about inflation, they wouldn't have reduced the QT by more than expected. And I think that sort of set a kind of a bullish framework for the comments that came after. When he didn't pivot, the market, there was a sigh of relief. I really don't quite understand why it sold off to that level back to the level of the announcement or pre-announcement, still up for the day, but still afterwards. I mean, let's face it, there has been some soft data. I mean, expectations were certainly on the soft side. We've seen some soft manufacturing reports, but we'll learn a lot more for Friday. Just 2 days away, we get the labor market data about whether there's a slowdown. We've seen some corporate earnings reports talk about April looking slower at the beginning of the second quarter. So there was a lot of talk about that. Although in the hospitality area and the gaming area and all that actually there was a lot of positive talk. But on some of the other calls, there was some negative talk. Although the beat rate on earnings is quite decent and quite good, I think, for the quarter. One has to realize that given the beat rate, which is 75, 77%, in a quarter that GDP was up 1 percentage point less than expected, that's a good sign, because if GDP beats expectations second quarter, one could expect that probably earnings will match or exceed their expectations for the second quarter.
We're seeing a number of people write in on the debt and the deficits and what's sustainable, and a few people have related that to the dollar, and that sort of kind of ties into that diversification question I was talking about. I talk a lot about how the dollar's become negatively correlated to the S&P with earnings, in terms of, more of our earnings are coming from abroad, and you look at the rising bond yields as feeding into this rising dollar relationship. But what's your, and so we could talk more for people who want to talk more about that and sort of the role of international portfolios. We're happy to talk a lot about that topic. But Professor, for you on the debt, the deficits, sustainable, what that means for rates, how are you looking at all that?
I do not see a debt capacity problem in the markets over the next several years. I think the deficits, not that I'm happy with them, but at $1.5 trillion into a global economy that's 80 to $100 trillion on flow is nothing that I think cannot be absorbed. Certainly, we have trouble on debt to GDP. It starts really in the mid 2030s. I'm not saying there couldn't be some sort of crisis one way or the other. I just don't see any crisis with the bonds and the deficit at the current time. And as I like to emphasize, for all you that are worried about inflation because of the deficit and monetizing the deficit, you want to be in real assets, and stocks are ideally positioned for that eventuality.
I know, Professor, when we've talked about the 10-year Treasury yield before, you like to look at 10-year real yields or 10-year tip yields. So any thoughts on that increase that we've seen of late? I think we're around 2.25, somewhere around that.
Yeah, we're exactly 2.25, having been moved up recently. Well, it got up, I guess it almost got up to 250 during that surge, I guess, late last year, and then went all the way down to 170, 180. I think we're basically at I think we're probably at a 2% tips long run. So it's very near that level. right now. That in the long run average, that's average. Of course, compared to the last 10 years, it's really high. But I remind people that when TIPS came out in 1997, they were selling at northward of 3.5% real and continue to rise beyond 4%. So it's certainly higher than recent history, but not at all high in total history.
So the follow-up to that would be there was a lot of discussion on this. I think there was an article in the Wall Street Journal over the weekend talking about the neutral rate. And if you could give us our thoughts there, do you agree with the Fed's current neutral rate, or do you think it's higher?
No, it's way too low. The current Fed neutral rate, which is the R-star, which is the real rate of interest consistent with balanced demand, they just raised it in the last meeting with the dot plot from 0.5 to 0.6%. I think it's probably 1.5 to 2. And then if you add the 2% inflation, you get 3.5. Basically 3.5 to 4 is the Fed funds rate equilibrium, not the 2.6 that they talk about. So it's below the current 5.3%, certainly by about 150 basis points, but not 300 basis points above it the way the current dot plot shows.
Mike wrote in a question about the unemployment rate and sort of some data on the state level versus the national level. And so you see some of the data and reports, I think from the Philly Fed, has talked about how state unemployment rates are moving up a little bit more than the national one. And then you got your favorite weekly indicator, the jobless claims, which has been not budging at all, sort of remarkable consistency despite all the headlines.
It has been remarkable because although it did tick down about 10,000 last week, it's really been about 220, 221, 222, remarkable consistency. I don't know. There's no reason. I've seen reports that that's a data problem and not just chance. I don't know this issue about whether state rates are higher. Obviously, the national rate has to be some sort of average of all the states. I have not actually analyzed any of that state data.
So a few more questions, I think, coming in here. One of them was on the inverted yield curve. Was it the biggest head fake ever this time around?
It's the first inverted yield curve in 60 years, not to produce a recession afterwards. Well, we've been talking about that for over a year or two.
Right.
And a lot of it has to do with, he said, and he said, it came out much better than we thought. We thought we were going to have much more unemployment. And he then, I'm talking about he, of course, Jay Powell said it's because of the supply side going up. But I think it has to do with inflationary expectations not going up. When this ran up because people thought it was supply side. And so it's going to come back down. And when you don't have inflationary expectations go up, you don't build it into contracts and wages. And that really helps you on the other side. Going to, Austin Goolsbee, who's now, of course, president of Federal Reserve Bank of Chicago, has actually concurred with that theory. He thinks that's the reason why we have not had a recession that follows it, because inflationary expectations did not go up with the inflation. And we could talk about why. But it didn't, and that is really helping us on the other way down, because it's reducing inflationary expectations that's so important, because inflationary expectations get built into contracts. And to crush those, you have to crush the economy. But if they're not elevated, you don't have to crush the economy, because they're already down at rates that are reasonable. And Powell mentions all the time, he's mentioned at every meeting over the last 3 years, inflationary expectations are well anchored as measured by survey data and financial markets. Of course, when he's talking about financial markets, he's talking about the difference between TIPS yields and the 10-year. So TIPS yields are 2.25. The 10-year is 4.6. So that's what, 2.4% inflation. And there are risk premiums also in that, but that's under 2.5% as a premium. So there's no, they monitor that difference, and they monitor the survey data. He mentioned the survey data. He said, although we did have a jump in the 1-year inflation rate, University of Michigan, we did not have a jump in long term, and that 1 year tends to be a volatile number. Yeah, I mean, it was, as I said, it was a very good, reasonable, did not panic, saying, oh my God, yes, this is a start of something. And I'm not panicking. Now that I see commodity prices come down, certainly this week is probably going to be the biggest decline in commodity prices in 6 months. And that's something, turns around here. We are seeing the softness that we need to stabilize that part, so that when the rent index and the insurance rates and all those really lagged inflation indicators start showing up into the official data, we'll get that impact to move it down to the low 2s.
We got a few people writing in, and this ties back to, Professor, your view on that real rate, the neutral rate, about, and you commented a little bit, but just connecting the productivity story to AI, about like how soon do you think AI is real? How much does that factor into productivity and that real rate question?
Well, I think if I remember the Goldman Sachs report, which was the most optimistic, which they said could raise 10-year rates from growth rates from 1 to 1.5%, said it's not kicking in until 2025. I believe maybe late 2024, but 2025. I do not have a strong feel on it. It's only been formally implemented in firms, 5 to 10% of the firms at this point. But and how much it's boosting? It's boosting, from what I remember, the firms that have implemented it have boosted productivity quite substantially as a result of it. So we will see how that finally plays out.
Kevin, here's a question maybe you could also chime in on. Somebody wrote in, they were watching Gundlach always on CNBC right after, talking about high yield bonds, 7 to 8%. How are you thinking about high yield bonds versus other bonds today? How are you thinking about the opportunities in the bond market?
Well, our conviction, or a high conviction trade, still remains, especially given where we're at with the Fed and the inverted yield curve, Treasury floating rate notes, that strategy in and of itself. And we've been barbelling that with our yield enhanced kind of aggregate core fund. But I think you can layer in, on the plus side, high yield. The one, I think, interesting thing about having 7 to 8% high yield, and I know our research and investment committee team has done a lot of work on this, showing horizon analysis, that even though spreads are at tights here, that even if you were to get a 100 basis point increase in spreads and or yields, you can still actually eke out a positive return. So I think it's interesting, because it's really part of the whole premise of this new rate regime, of where rates are, where fixed income yields currently reside at. A lot different story than where we were, say, after the financial crisis, when you were looking at 4% high yield. So certainly something to focus on there. I wanted to get both of your kind of opinion on this next question that I saw come in. Why are digital assets falling in an atmosphere of continuing inflation? Digital assets obviously in the news a lot, so I thought that would be a timely question to ask both of you gentlemen.
Let me answer. What moves Bitcoin is, like what moves the weather. I would say the following. The halving, everyone was buying it was a crazy story, in my opinion. The halving was the rate at which the Bitcoins, which are already, over 90, 95% or so supplied, is going to be added every year. Compared to the stock of Bitcoins, the halving was trivial. And yet people were bidding it up like suddenly there was going to be a shortage of Bitcoins and it was going to go up. Well, the halving occurred and hey, where's the demand? And I think it's a disappointment from that. And when yields go up, that's not good for Bitcoin either. One reason gold has actually been soft recently. So I think a combination of I think the myth story about what the effect of halving was going to do, and then combined with the higher yields, I can certainly understand why Bitcoin broke downward in recent days.
There's a few questions on valuations in equities. One was asking, you got Warren Buffett meeting this weekend. His question, somebody was asking about the Buffett Indicator for valuing the market, and somebody else wrote in asking about the Shiller-Cape ratio and some of the issues with margins and how margins might change over time tied to that. But maybe give your view on a few of those topics and where valuations are today, what that means for your outlook for the market.
Well, I'm glad you asked that because it's a good time to recommend our book, Jeremy, Stocks for the Long Run, 6th edition, because we extensively talk about the Buffett Indicator and we extensively talk about the Shiller-Cape ratio. On the Buffett Indicator, I've been saying for a long time that it's not right to take the value of U.S. stocks relative to U.S. GDP when more and more stocks over time get their profits abroad. That's why the trend is upward. As far as the PE ratio is concerned, I've often voiced that 20 PE is an equilibrium PE. That's what we have exactly going forward right now on the market. Of course, you have the tech stocks selling 25 to 30 or more, much more. Well, tech itself is probably 25 S&P and probably about 30, 35 on the Mag 7, 35 on the Mag 7. And then you go away from that and you get 15, 16, 17 or lower, and you get much lower PE ratios on that. Of course, these growth stocks have performed. And that's why they sell at different yields. But people sometimes underestimate how much extra growth you need to justify really high PEs. And they also, underestimate how little growth is required on low PE stocks to give them an extremely good yield.
I think we've hit the big picture. So, we do these calls post-Fed. We also then help people. There's a lot of questions of how do you think about managing, putting these in portfolios. We have some Professor Siegel branded model portfolios on different platforms. So if you're looking for our suggestions, how to take the best from the macro and put it into portfolios, please reach out about how we might be able to work with your platforms. And it's been a fun conversation, Professor. Thanks for always sharing your insights on the Fed. And Kevin, always great to be on with you.
Thanks. Same here. Looking forward to June. Onward and upward.
Thank you.